India has seen dramatic shifts in recent years, like increasing investment interest from the global investors. How do you see the role of Indian VCs evolving in this landscape, especially as competition from global fund intensifies?
I think all this starts off with the Indian startup ecosystem. We're the third largest ecosystem in the world as of now, but we are the largest ecosystem that is overly reliant on foreign capital. If you look at the US market ends up actually getting a large number of domestic VCs to end up at domestic capital to invest. China also grew on the backs of foreign capital, but now they have strong domestic institutions and investors as well. In India, the industry estimate is that close to 85% of the money raised by Indian startups actually comes from foreign sources as of now. And because the Indian market is fairly open, the largest VC in India is not actually Indian. They're actually a foreign VC on the same. But what we are actually seeing as of now is a number of homegrown VCs which are either regulated by SEBI or by the IFSC regulator in GIFT City. For that matter, they are actually leading the charge as of now. We're a young industry. We're just about 10 odd years in terms of the actual homegrown VC market, but it's actually growing at a phenomenal CAGR as well. The entire alternative space in India manages over 12 lakh crores of capital commitments as of now. That is a very, very high sum. And what we are actually seeing is the government is actually playing a fantastic role to the fund of funds to become the anchor investor to a number of VCs. So while we may have close to about 500, 600 fund managers in the country as of now, my estimates is by about 2030, we should end up actually seeing close to about 2,500, 3,000 odd VCs of size. And we'll end up actually seeing domestic VC play a far, far greater role in the capital cycles of India compared to foreign investors themselves.
But it's a huge number of 85% of VCs from the outside.
Of course, but if you actually look at it, the reason why we had a large amount of foreign capital was because of flawed policies from the government. We had a situation wherein unlisted investors actually paid a tax rate at one point was 2.4 times the tax rate paid by listed investors. So an Indian investor would actually look at it and say, why should I put money into a startup that is illiquid, that is high risk, when I can actually put the money into the stock market? I can invest on a Monday, get out on a Tuesday or a Wednesday for that matter, and get that kind of liquidity. So we had a tax policy that would actually incentivize people to go into listed stock as opposed to unlisted. But thankfully, the Modi government has remedied that as of now, made a uniform rate. And because of that, the role of domestic capital is going to slowly end up actually increasing and compounding over time.
You have worked with a wide range of entrepreneurs. In your experience, what are the key characteristics that separate successful founders from those who struggles?
The greatest risk in investing is not actually regulatory risk, credit risk, capital risk, them running competition risk, etc. It's actually people risk. So I think the first and foremost thing is the person trustworthy? Because see, ultimately, in the entire business cycle of the life of the startup, they do well, they may not do well, there'll be a number of crises. But the true mettle of a person is actually tested when their backs are actually against the wall. So I think the first and foremost is the person trustworthy? Is the person competent? Does the founder have great domain expertise? And how receptive is the founder to feedback? I know there is this prevailing notion that the founder knows best and the founder has his hands on the pulse. But look, a founder doesn't. I think it's very important to actually learn from other people's mistakes. So to get feedback from a number of people, make your own decision. But that feedback synthesis is actually critical. So if a founder can have these kind of attributes, be trustworthy, be open and transparent, have deep domain expertise, and be receptive to feedback while having the ability to take their own decision, there is a founder who will end up standing out regardless of the business cycle.
Just adding to that a question, how do you assess risk and what have been some of the most valuable lessons while investing in the early stage companies?
I think the greatest risk we have in the early stage is actually people risk. Like if you look at most early stage investors end up actually investing into an idea or it's barely an MVP that ends up actually getting created out of there. And what ends up happening at that point in time is the assumptions of the founders may not end up actually matching with the reality of the market. So because of that, the ability of the founder to end up actually pivoting, changing, assessing and understanding the needs of the market and creating a product or service that matches to that, that is actually essential. So if you look at the risks also for that matter, differs from industry to industry. People risk is of course the highest. If you work in a sector like fintech, for example, there is a high degree of regulatory risk that also ends up actually prevailing there. There's also, I would say, capital risk because if your nearest competitors raise 20 to 30 to 40 times the money you have, they can end up actually crowding you out of the market through the sheer force of capital itself. So there are a number of risk factors. It differs from industry to industry. These are the three most common ones that anyone ends up actually looking at.
Just a last question, Siddhart. How do you foresee the fintech startups growing in 2025?
I think fintech has been one of the areas that has attracted the most amount of capital over the last 10 odd years. And the same has always been either number one, number two, or number three, but definitely in the top three. And in fintech, as of now, what we are actually seeing is the fintech innovations actually moving away from just lending or stockbroking or credit for that matter or underwriting itself. They're actually now going towards debt resolution. They end up actually going towards working with BFSI institutions to make them to improve their tech stack on the same and to make integration with the larger BFSI ecosystem far easier. So we will end up seeing the evolution of a tech part play a far greater role merely than the movement of money itself. So it's going to be very interesting times for Indian fintech. I think as UPI goes global also, there are immense amount of opportunities for Indian fintechs to end up leveraging that, and that's going to be a very interesting area to see.
Thank you so much, Siddharth. Thanks for your timing.